It's the 12th of December 2017. Welcome to Compass Global Markets Weekly Update. I'm Tony Boyajian. We'll kick off with some events in the US overnight. We've seen the US dollar and US equity markets in particular come off initially on news of a failed terror attack in New York City before the markets recovered a tad. However, investors are still quite cautious given that this Thursday morning our time, the US Federal Reserve will make an interest rate decision, which has already been fully priced in for another 0.25% rate hike in the United States. Now, this will be the third hike this year in 2017, and perhaps the last hurrah for outgoing Fed Chair Janet Yellen, whose role will be taken over by Jerome Powell in February next year. Now, on Friday night, we saw some US jobs numbers come out. They were quite strong at 228,000 jobs created in the month of November. However, most of these are in low-paying, if you like, or low-income industries. The unemployment rate still remains at 17-year low of 4.1%, but more importantly, the wages growth figures remain quite elusive. Wages growth is stuck at 2.5% per annum in the United States. Now, some global asset managers out there are calling a US recession in 2018, and the chance that they are basing that on is around about a 25% factoring in. Now, the big questions are, will the US Fed be dovish or hawkish based on Thursday's rate hike decision? You know, it's a positive global growth story versus a weak inflation background. The risks, however, to the consumer outlook remain skewed to the downside. And the second question is, will the impending US tax cuts provide further stimulus to the US economy, or will it just increase the US debt burden? Now, elsewhere in the UK and the EU have reached an agreement on Brexit terms, which includes the management of the Irish border. However, the sterling pound does remain weak because UK Prime Minister Theresa May said that the UK will not pay the £39 billion divorce bill until trade negotiations are sorted. So it looks like those deliberations will continue. The euro has strengthened a little after Chancellor Angela Merkel provided reassurance that the coalition government talks in Germany will be resolved quite quickly. Let's not forget the Catalan election is only 10 days away, so we could see some more volatility in the euro space. In Australia, last week's GDP or economic growth figures were for the third quarter showed that the economy expanded by 0.6% or 2.8% per annum, less than expected. We've also seen the RBA lower its growth forecasts for 2019. So this expectation that interest rates will remain on hold certainly is long lasting. Now, when we look at the household consumption levels, they remain quite weak, and given that 60% of the GDP number is based on household consumption, it's not a surprise to see that income growth continues to be the Achilles heel for Australian consumers. The Australian dollar remains weak, around 75 US cents. It's near 6-month lows after we saw a sharp narrowing last week of the trade surplus figures for Australia. Now, the numbers that came out were for October 2017. It fell from 1.6 billion to just over 100 million. This is the country's trade surplus. It was mainly due to a fall in exports and a rise in imports. Now, the next technical level of support for the Aussie dollar on the downside is 74.8 US. Beyond that, the charts indicate a move to 73 US cents. On the top side, 76 US remains resistance. Don't forget to watch us on Thursday lunchtime on channel 602 Sky News Business for our latest financial markets wrap. Have a great week.